Alright, this teaching series I will be talking about the push-pull algorithm. For many of you who've been following us for a long time, you kind of know about our general methodology in trading. Our NQ Active Trader package currently consists of 5 algorithms. Each one is kind of designed for a different market condition. Our goal is to have a couple algorithms that do good when the market goes up, a couple that do good when it goes down, and some overlap when it goes sideways, and then one that does good in particular during short covering rallies. Our push-pull algorithm is called the P2 push-pull. It trades the 10-year note, and it's part of our suite that is attempting to do good when the market goes lower. When the S&P goes lower, typically the 10-year will rally. It doesn't always happen, but that's what the backtesting shows, and in general that is what tends to happen. Before I start though, I would like to go over our standard disclaimer. Okay, so as most of you are aware, we are a third-party trading system developer. We're an unregistered CTA. We claim the self-executing exemption that the CFTC provides in the NFA. Our algorithms are based on computerized models. We don't provide specific advice to people, and we don't hold ourselves out to the public as a CTA. We're simply in the business of selling trading algorithms that are for use on a personal computer or that can be executed with an auto execution broker. I'd also like to add that futures trading is not for everyone. There is risk involved. You can take substantial losses in the futures market, and like I said, it really is not for everyone. The last thing I'll say is that most of the data that we provide is based on back-tested or simulated accounts, and so what that means, and you can refer to our website for the CFTC disclaimer on that, but essentially what it means is that since they are based on back-testing, they have the benefit of hindsight, and they can also overcompensate for slippage, and meaning that the fills might be slightly different than what we post on the live trades. Having said that, we do also post statements which do include slippage and commission. They're from customers that are actually trading our algorithms, but again, since we're unregistered CTAs, we don't, none of that data is audited by any government regulatory agency, and so just keep that all in mind as you process some of the data that we show. And if you have any questions regarding your situation, reach out to a licensed CTA or your registered investment advisor, and they can provide advice for your specific situation. With that, I would like to get into the push-pull algorithm now. Okay, so what you're looking at here is a chart of the push-pull algorithm. As what most of you are probably used to seeing is the 5 charts that we show. So the overnight gap, the burst, the breakout, the short, and then the push-pull algorithm. In this teaching series, I would like to really just focus in on the push-pull and give a few details on in general what it's doing, some of the strengths and weaknesses, and just kind of talk about how it fits into the complete system. So with algorithmic trading or automated trading, the basic idea is that you take a chart, something like this. This is actually the 10-year note, and this goes all the way back to May 2001 and all the way until now. And you have this chart, and what you do is people like myself will write algorithms that attempt to find patterns in the futures contract that's being traded on the chart. And once we have code written, then it'll get applied to the chart like you see now. And I'll actually turn it off for a second so you can kind of see what I mean. So this is just the 10-year note now, and what I can do is go ahead and add this strategy to the chart. And what TradeStation is doing is looking through the chart and analyzing and figuring out where a trade would have been placed, and the stop, the limit, everything. And so when it's done, you get these kind of blue dotted lines as well as these red dotted lines. The blue dotted line represents a winning trade, just like this one here that we got in on the 1st of December. We got out on the 15th of January. So we held this trade for about 6 weeks. Now the push-pull is the only algorithm that we have that can hold really longer than a week. The other ones can as well, but they just don't because their targets and stops are way tighter. This one has fairly wide stops and targets, and there's a reason behind that I'll kind of get into. But what that does is it allows it to hold for a couple weeks to a couple months. It doesn't always hold that long. Here's a run that we had in August of last year where we got in and we got out about 5 days later, and we jumped back in, got out about 2 weeks later, and then here's another one that we were in for about 3 weeks, I think. So it just kind of depends on what the market does. Now, with this one, once you have the algorithm loaded and all the trades populate, you can actually look at a performance report that TradeStation will provide. Now, the way I have this set up is to trade one contract, which is how it works in our NQ Active Trader package. So for every 15,000 in your account, you could trade one contract on each of our algorithms, and so that would include one on the push-pull. And what this shows is how trading one contract would have done since '01. And so this is an annual report. This would be a monthly, where you can look at how each month actually did. It'll also give you something called the profit factor. The profit factor is really just a ratio of gross profit to gross loss, and so you want a profit factor of at least 1, but ideally you want it to be at least about 1.2 to 1.3 above that. I mean, the tricky part is it's also possible to have a profit factor that's too high, believe it or not. In my experience, any profit factor above about 2.5 is subject to, or more than likely, the result of over-optimization. So the sweet spot, in my opinion, is really between about 1.2 and about 2.5. Our algorithms range in anywhere from about 1.25 to 2.24, which is this one. So this algorithm of the 5 that we offer has the highest profit factor, and but that's just part of it. So you also want the total number of trades to be at least 200, in our opinion. You want to back test as far back as you can, and on the 10-year it is all the way back till around May of 2001. The other thing that it shows you is the percent profitable. So this algorithm is 82% winning. It'll also give you the entire trade list, so every trade that was placed. It'll give you an equity curve, which that's what this is. So it starts in '01, and this is just a measure of every time a trade is closed, it adds to the kind of hypothetical balance, starting balance of 0, and then goes onward. And so one thing to think about on this one is that we went live with this algorithm actually around November 2014, I believe. And since then, so about right in here, since then we are higher, and so this algorithm has done really well since we started trading it live. We officially rolled it out in our V2 March release of 2015, and that's when the majority of our customers started trading this one. But the bottom line is this one has done good since we last optimized. It's profitable, and it's actually done really well. One thing I want to show you here is, so I can talk about the strengths of this algorithm. Essentially, what we do with this algorithm is we think of it as almost like a hedging algorithm. We don't like to use the word hedge, because that implies things that I don't think are totally true. Namely that if the market goes lower, this one will definitely protect us. That's not always the case. What this algorithm does, along with our short algorithm, is attempt to give us an algorithm that will do good when the market goes lower. And the reason why we feel that this one will continue to do that is for a couple reasons. One, the best years that this one has had have been on years where the S&P was down. So everyone knows about 2008. The S&P closed down over 30%. I think it was more like 39. This algorithm had its best year in '08, made about 18,000. Another losing year on the S&P was 2011. Although it wasn't a huge loss, it was on the order of, I think, less than 1%, but it still closed red in 2011. This one had its its third best year in 2011. And then '03 was another year where the markets were down and this algorithm was up. I believe '02 was the same. So backtested, this data shows that this algorithm will keep doing good if the market goes lower. What we've seen in live trades has been very similar. And let me pull up my Excel spreadsheet to kind of go over that. Okay, so this spreadsheet is one that a lot of you have seen before because I've used it in some of the blogs. But what it does, it shows the NQ Active Trader package V2 with all 5 algorithms. And we're talking about the push-pull, so I'd like to focus on this. I gave the example of back-tested how it's done when the market's gone lower. This data here is more of a walk forward. Since we optimized this algorithm in March, we've had a couple notable months where the S&P closed down. One was August of 2015. The other is more recently, January 2016. Now keep in mind today's the 19th of January, so January is not done, but at least so far this algorithm has done really well in January. So in August you had the market sell off pretty intensely, and this algorithm actually was profitable by about 1,200. The January 1st was a similar thing, where we made about 2,800 on this algorithm. And again, this assumes a 15K account. The other periods of relative weakness were in kind of July of 2015 and September. This algorithm also did pretty good. Now what's interesting is October the market rallied, and October the market rallied and we did take losses on this algorithm. So this algorithm's strength is when the market goes lower. Its weakness is when the market goes higher. And so it does act like an equivalent short algorithm on the indexes. And to kind of further show that, what I want to do is just pull up, right here is a chart of the S&P. So let me kind of pull these up so we can kind of compare, and I can show you kind of what I mean. So let's see. So the start period over here is around November 27. So let me zoom in a little bit. So that's a similar period on this chart. So what you see is this is the big market sell-off that we've seen in January so far, and you can see that the 10-year rallied. And it doesn't always move 100% inversely to the S&P, but it tends to definitely move in that direction. Now we could look at other periods as well, like '08. In fact, why don't I do that? Let's kind of go. Let's see if I can find 2008. So that's 2013. 2011. Well, 2011 was another period where the market struggled, and you can see that. Let's see. So right in here is January 2011. You can see the 10-year pretty much rallied throughout that period, which is why, again, this algorithm did well in 2011, back tested, and we expect that if the markets sell off again heavily, that this algorithm will do good again and provide some protection. Okay, here's 2008. So right around in here is when, in 2008, when the market took the most losses, and you can see that this algorithm had a ton of amazing trades right all throughout the move lower that the S&P saw in 2008 and around October, November, December. and I don't really want to count them up, but you can see throughout this entire move, this algorithm got in and out, and had an amazing run. So once again, this algorithm's purpose is to help protect us when the market goes lower. And in live trading, that's for the most part what we've seen. I think the last thing I want to comment about this algorithm is that it will take trades that make us all very uncomfortable. It'll do things like buy when the market kind of at highs and in relative highs, it'll buy. This trade made all of us uncomfortable. Sold off, rallied, sold off, rallied, sold off, and then it rallied. But the reason why we have a big stop on this algorithm is to give it enough room so that if the market does rally some, this algorithm won't immediately get stopped out, and we can stay in so that eventually when it does sell off, the market that is, this algorithm will then take its gains. What I want to do is show you a few, because it does have the biggest stop of all of our algorithms, because again, we want to give it room. I do get emails occasionally asking, how come our stop is so big? Why don't we make it smaller? Right now it's about a $2,300 stop, and what I want to do is show you what everything looks like if you change the stop to something like $1,000. So the key things for us to look at is the profit factor right now is 2.24, and we have about an 82% win rate. And I'll also show you this again, this equity curve, which is about as good as it gets in my opinion. What I want to do now is change the stop so that it's about $1,000 stop, just so you can kind of see what would happen. So if instead of a $2,300 stop we had a $1,000 stop, then let me show you kind of what happens. So first off, you can see pretty quickly that we would have still gotten in here, but now we would have got stopped out. We would have jumped back in here and then got stopped out again, jumped in here, got stopped out again. We finally would have had a winning trade right in here that would have worked out well. But and if we go back in time, you'll see sometimes that would work really well, sometimes it wouldn't. In here, it is probably about the same as what we have now. Let me see if I can find an example where it would have worked really well. Let's see, probably, well, that wouldn't have worked well. Yeah, I'm not sure I'll be able to find one, but what you can see though is it just gets stopped out a lot earlier. The real proof of the pudding though is if we go to this strategy report and we can compare it to what it looks like with a $1,000 stop and what it looks like without one. So first off, you'll notice the profit factor drops all the way down to 1.3, and so we do end up taking more losses, but the gains are still on the 200K range. You can see the win rate is a lot lower. It's only 65%. We do have more trades, and that makes sense because you get out, but then you get back in. But the bottom line is that it just doesn't do as well. And so that is why we have a stop of about $2,300. Now, that stop is not a stop that I necessarily like, because if we do get stopped out, it usually is a pretty big hit. But the reality is that it doesn't get stopped out that often because it is so big. Now, it does on occasion, and when it does, we do take a hit. But keep in mind, this is just one of the algorithms. So what I want to show you here is October. So this is an October trade where we got stopped out. We took a $2,300 loss right here. But the other algorithms did amazing through this period. And so again, our methodology is not that we have one algorithm that always does good, but that we have one that does good when the market goes higher, one that does good when it goes lower, and then one that does good in a sideways market, and one that does good when we're in a short carbon rally, and then one kind of catch-all, which in a lot of ways is this 10-year note. So it as long as we have net one winning algorithm, then in general we should do okay. So again, in October we took losses on this algorithm right here. We got stopped out. But what I want to show you is how the other algorithms did in October, just real quickly to kind of make my point. Right in here is October, when our 10-year was selling off and we took losses all throughout here on the 10-year. Well, the overnight gap did amazing. And so when you add them all together, we are still ahead. So let me go back to my Excel though and show you that again. Okay, so here's the Excel, and you can see again that we took losses on the push-pull, about 1359. Now the reason why that's not 2300 is because earlier on in October we had some gains, but you'll see that the overnight gap made about 2497, the burst about 1000, and the breakout just kind of didn't really do anything. So when you add it all together, we did about 1800 on the simulated account. And so even though the 10-year took losses, we did okay. And you see that happen time and time again. Now, there are occasions where it does bad and the other algorithms don't do good enough. This is an example of that, where, yeah, the 10-year note did bad. The overnight gap did really good. The breakout did pretty good. But we had losses on the burst and the short algorithm, so we ended up taking a losing month. But in general, over time, this kind of event should be relatively rare, and these kind of events much more common, where it does work as we have them designed, where a couple are doing really good, and then maybe one doing really bad, and then the other one's just kind of not doing a lot, to where we're net ahead one algorithm. And then there's times where two might be ahead by a lot, like in September, and none of them are really down. And that's usually when we post a kind of 20% kind of month. So I think with that, there's probably not a lot else that I can talk about with regard to the push-pull. The last thing though is people will notice that it does move the target on occasion. On this trade in particular, when we first got in, our stop was, I believe it was somewhere around in here, and then as the market rallied through here, it actually moved the target higher, and it does that on this algorithm for a few reasons. One, when economic news comes out that causes the 10-year to rally, a lot of times you will get really huge spikes in the either overnight or in the day when the data is released. Here's a great example on the 2nd of October. I believe this was probably the jobs report, and because we move our target higher, we're really looking for some big pop to happen at some point that'll blast through our target, we'll get out, and then we get back in. Now when we get back in, and a similar thing happened here more recently, we got out on this spike and we got in on the next red bar. Even though we get right back in, the good thing is that now the stop for this trade is much closer to our original entry back here. So it almost has the effect of a trailing stop, where we get out, we wait for a small pullback, we get back in, and now our stop is somewhere more in this area. So if we do get stopped out of this trade, if you add the previous trade plus this one, we will either be slightly ahead or slightly down. So it's just the style that we use, but it really is all based on the back testing and what the simulations tell us we should do. If and we've run simulations where we don't move the stop, and when we do that, the results aren't quite as good. So that's why we do that. We will never move the stop, however. So once we have a stop triggered, or once we get in a trade at the very first point, $2,300 from that point is our stop, and so we never move that lower or higher. I think that's all I have though. So this algorithm though is definitely probably the best one we have. It's definitely the second best one since we started live on it, and we expect it'll continue to do well. We have a ton of requirements that we use when we backtest, because we don't want to over optimize. Nobody wants to have an algorithm that looks good on paper, but then traded live doesn't do well. So we do a lot of stuff to try to ensure that we're not over-optimized. When we optimize, we do it on fairly large increments, so we're not optimizing down to the exact point. We modify the inputs plus or minus 10% to make sure that the algorithm holds up okay. We go back as far as we can. We've also done walk forward analysis, which someday I'll do a teaching series on that. But we've done everything we can to try to break these algorithms and make sure that we believe in them and that there's nothing that we're missing on them. So I think I'll close with that. But if you have an interest in the company with what we offer, feel free to reach out to us. We'd love to give you a demo, walk you through the 5 algorithms, and discuss what we do. But again, keep in mind we're not registered CTAs, so any advice is impersonal. And essentially what we're able to do is present the data that our algorithms have, and then let you make your choice. You are able to trade these on either TradeStation or through an auto execution broker. And so both are an option, and we have a few options on the auto execution side. So anyway, have a great day, and thanks for watching. And once again, I after I watch these blogs, I realize how slow I talk. So I do apologize for that. I'm an engineer. I'm not a marketing whiz guy, and so you kind of get what you get with me, I guess. But so yeah, if there was a way that I could fast forward the blogs so that it didn't sound like I was talking so slow, I'd be more than happy to do that. But anyway, thanks for following along, and have a great week and great year, hopefully. Have a good one. Bye.